Every year, more than 40,000 Canadians pack their bags and leave the country, but what most don't realize is that crossing the border can trigger a hidden tax bill bigger than some people's life savings. Imagine selling nothing, moving abroad, and still owing thousands of dollars in taxes the moment you leave. The rules are changing again before 2026, and for many, this could mean losing their home exemption, facing penalties on investments, or even being taxed twice on the same income. These rules are not just for the wealthy, they affect anyone with a house, retirement savings, or simple investments. If you're planning to leave, the truth behind these 10 tax traps could completely change your plans. Number 10. Tax treaty benefits. For Canadians moving abroad before 2026, one of the most effective tools for reducing taxes is the network of tax treaties Canada has signed with many countries. These agreements are designed to prevent double taxation, which happens when both Canada and your new country attempt to tax the same income. A treaty clearly assigns taxing rights to one country or sets reduced rates for certain types of income. For example, while Canada normally withholds 25% on dividends, pensions, or royalties paid to non-residents, many treaties reduce this rate to 15% or even 10%. This ensures you keep more of your money instead of losing a large portion to withholding. Without claiming these treaty benefits, you could end up paying far more tax than necessary, weakening the financial advantage of your move. Beyond lowering tax rates, treaties also address the complex issue of residency status. In situations where both Canada and your new country claim you as a resident, a treaty applies a tiebreaker test. This considers factors such as where your permanent home is located, where your family resides, and where your economic interests are strongest. By applying these criteria, the treaty determines which country has the right to treat you as a resident for tax purposes. This is essential, because being considered a tax resident in two countries at once can lead to conflicting filing requirements, legal disputes, and excessive tax burdens. Treaties also outline processes for resolving disagreements through a mutual agreement procedure, providing an important safety net in cross-border situations. The practical step is to carefully review the treaty between Canada and the country where you plan to settle. Each agreement has unique terms, and the benefits are not applied automatically. You must usually submit forms and elections to the CRA or to financial institutions in order to access reduced withholding rates. Understanding exactly how your income sources, whether pensions, investments, or property, are treated under the treaty can save thousands annually. For Canadians departing before 2026, using tax treaty benefits is not simply a legal formality, it is a crucial strategy for protecting wealth, avoiding double taxation, and ensuring smoother financial integration in your new country. Number 9. Reporting obligations abroad. One of the most misunderstood aspects of leaving Canada is the set of ongoing reporting obligations that follow you even after you become a non-resident. Many believe that once they file a departure return, their ties to the Canadian tax system end, but this is not accurate. Non-residents must still report certain types of Canadian source income, including rental income, pension payments, dividends, and proceeds from selling taxable Canadian property. Depending on the type of income, this may involve filing a non-resident income tax return or paying through withholding taxes. Failure to file the proper forms can result in penalties, reassessments, and interest charges that add up quickly. The rules are strict, and ignoring them often creates greater costs than if compliance had been managed correctly from the start. The challenge becomes even more complex when combined with the tax laws of your new country of residence. Many countries require residents to declare foreign assets and income, which means Canadians abroad must disclose Canadian bank accounts, investment portfolios, or property. Some countries impose severe penalties for failing to report these holdings, and in many cases, the income must be taxed locally as well. This overlap often leads to double taxation, where the same income is taxed in both Canada and the new country. While tax treaties can help by assigning taxing rights and allowing credits, they do not eliminate the requirement to file returns in both jurisdictions. The responsibility remains with the individual to coordinate reporting correctly. The practical step is to create a compliance strategy before departure. This includes confirming which Canadian forms will still need to be filed, keeping detailed records of Canadian source income, and understanding the reporting requirements of your new country. Professional advice is strongly recommended, particularly from advisors with expertise in cross-border taxation, since mistakes are costly and often difficult to reverse. Filing on time also ensures eligibility for treaty benefits, which can reduce withholding rates and prevent unnecessary double taxation. For Canadians leaving before 2026, recognizing that tax obligations extend beyond borders is critical. Meeting these reporting obligations preserves financial stability and protects you from costly surprises years after emigration. Number 8. Property ownership rules. For Canadians who leave before 2026, owning property in Canada can trigger a series of unique tax rules that continue even after residency ends. If you choose to keep your property and rent it out, rental income is subject to a 25% withholding tax on the gross amount collected. While you can elect to be taxed on net rental income by filing the correct forms, failure to do so means higher tax obligations than necessary. On the other hand, if you decide to sell property as a non-resident, the buyer must withhold a percentage of the sale price and remit it to the CRA until you obtain a clearance certificate. This process ensures that Canada secures its right to tax gains connected to real estate, even when the owner lives abroad. Ignoring these procedures can create delays, penalties, and unexpected tax liabilities. Adding to the complexity, Canada has introduced new measures such as the Underused Housing Tax, UHT, aimed primarily at non-residents who own vacant or underutilized residential property. Even Canadian citizens who become non-residents may be required to file UHT returns if they retain property that is not their primary residence. The tax applies annually and can result in significant penalties if ignored. In addition, foreign buyer restrictions, while targeted at non-resident investors, indirectly affect Canadians who change their residency and later wish to purchase another property. These regulations highlight that real estate ownership is closely monitored, and emigrants must remain vigilant to avoid unintentional noncompliance. The practical decision is whether to sell, rent, or hold the property. Selling before departure eliminates future tax complications and allows you to fully claim the principal residence exemption if the property qualifies. Renting can still be profitable, provided the correct elections are filed and maintenance costs are carefully tracked. Retaining property but leaving it vacant, however, exposes you to taxes such as the UHT and ongoing costs that reduce overall value. For Canadians leaving before 2026, property ownership is more than a personal choice, it is a financial strategy that must be evaluated in light of complex tax obligations. Proactive planning ensures property remains an asset rather than a liability abroad. Number 7. New tracking rules for days spent in Canada. Residency is one of the most important factors in Canadian taxation, and recent updates have strengthened how the CRA tracks days spent in the country. Traditionally, anyone who spends 183 days or more in Canada during a calendar year is deemed a resident for tax purposes. However, the rules go beyond a simple day count. The CRA also considers residential ties, such as owning a Canadian home, keeping a spouse or dependents in Canada, or maintaining memberships, health coverage, or bank accounts. New systems for border data sharing mean the government now receives highly accurate information on your entries and exits, leaving little room for error. This makes it much harder to maintain non-residency while still frequently returning to Canada. Even if you spend fewer than 183 days in Canada, the CRA may still classify you as a factual resident if your ties are strong. This could force you to file a full Canadian return and report worldwide income, which may lead to double taxation unless a treaty applies. The risks are high for those who try to split time between Canada and another country without cutting ties. If the CRA challenges your residency, it can reassess past years, apply interest and penalties, and create a significant financial burden. The presence of a tiebreaker in tax treaties may help if both Canada and another country claim you as a resident, but relying on treaty provisions is complicated and often requires professional assistance. The increased emphasis on monitoring days spent in Canada underscores the need for careful record-keeping and deliberate planning. The practical approach is to maintain a detailed travel log of every entry and exit, supported by border crossing records. Reducing ties such as canceling provincial health coverage, updating driver's licenses, and closing local bank accounts strengthens your non-resident position. Families should carefully consider whether dependents remain in Canada, since their presence can weigh heavily in residency determinations. For Canadians leaving before 2026, overlooking the new tracking rules could undo the benefits of emigration, pulling you back into Canada's tax net. Properly managing time and ties ensures that once you leave, your status as a non-resident remains clear and defensible. Number 6. Impact on investments. For Canadians planning to leave before 2026, the way investments are treated under tax law changes significantly. When you become a non-resident, Canada applies the exit tax to most of your worldwide assets, as if you sold them on your departure date. This creates an immediate tax liability on unrealized gains, which can be substantial if markets are strong. After departure, only certain assets remain taxable in Canada. Publicly traded shares on Canadian exchanges, for instance, generally stop being taxable once you are a non-resident. However, other holdings such as shares of private corporations, partnership interests, and Canadian real estate remain fully taxable even after you leave. Many people assume all investments are treated equally, but the law draws clear lines that can have lasting financial consequences. Income generated by Canadian investments also attracts specific rules. Dividends from Canadian corporations are subject to non-resident withholding tax, often 25% unless reduced by a treaty. Certain types of interest income may also face withholding, depending on how the investment is structured. Meanwhile, capital gains on Canadian real estate are still taxable, and buyers of property from non-residents must withhold part of the purchase price until the CRA issues a clearance certificate. This system ensures that Canada collects taxes tied to property and income within its borders, even if the owner lives abroad. As a result, emigrants must balance their desire to keep Canadian investments with the reality of potentially higher tax exposure and more complex compliance obligations. The practical step is to review your portfolio before departure. Some may choose to sell Canadian securities while still residents to reset cost bases, avoiding future complications. Others may explore restructuring ownership through corporations or trusts to reduce exposure. Timing is critical. Disposing of assets during a market downturn can lower the deemed gain and reduce the exit tax. Consulting a professional who understands both Canadian and international investment taxation helps avoid costly mistakes. For Canadians leaving before 2026, grasping how the move reshapes taxation of investments ensures you preserve long-term wealth and avoid surprises that could erode the financial benefits of relocating abroad. Number 5. Non-resident withholding tax. When Canadians change their residency status, they quickly discover that Canada taxes certain types of Canadian source income at the point of payment. This system is called the non-resident withholding tax, and it applies to streams such as dividends, pensions, rental income, royalties, and certain interest payments. The standard rate is 25%, which is deducted before you even receive the funds. For example, if you are entitled to $2,000 in dividends, the payer will withhold $500 and remit it directly to the CRA. For retirees relying on pension income or property owners renting Canadian real estate, this can significantly reduce cash flow. Many people assume they are finished with Canadian tax once they leave, but withholding rules ensure that Canada collects on income earned within its borders. The system becomes more favorable if a tax treaty exists between Canada and your new country of residence. Treaties are negotiated to prevent double taxation and often reduce the withholding rate from 25% to something lower, commonly 15% and sometimes even 10%. For example, certain pensions or annuities may qualify for reduced rates if you file the appropriate treaty election forms. Without submitting the forms, the default higher withholding applies automatically. While the withholding tax generally satisfies your Canadian tax liability, you may still be required to declare the income in your new country, depending on its laws. This makes understanding the treaty provisions critical to ensuring you do not pay more tax than necessary. The practical approach is to analyze your Canadian income sources before departure and determine how they will be affected. If you hold dividend-paying stocks, consider whether they remain attractive after withholding. If you own rental property, evaluate whether net returns justify the tax obligations. Retirees should confirm how much of their pension income will be withheld and what paperwork is needed to access reduced rates. Planning in advance preserves income, avoids overpayment, and ensures smoother financial transitions abroad. For Canadians leaving before 2026, awareness of the non-resident withholding tax is not optional. It is a vital piece of the financial puzzle that safeguards long-term stability while living outside the country. Number 4. Departure tax deferral. The departure tax can create one of the largest financial burdens for Canadians who become non-residents, but the rules do provide a possible relief known as the departure tax deferral. Under this option, instead of paying the full deemed disposition tax immediately, you may elect to postpone payment until the asset is actually sold. This is particularly important for individuals holding illiquid assets such as private company shares, large investment portfolios, or family businesses. Without deferral, people might be forced to sell valuable holdings prematurely simply to cover the tax bill. The government recognizes this challenge and offers a mechanism to preserve assets while still securing its right to eventual payment. However, it is not automatic. You must file the proper election with the CRA by the deadline in order to qualify. A key requirement for this deferral is the provision of acceptable security. The CRA typically demands some form of guarantee, such as a letter of credit, bond, or mortgage on Canadian property, to cover the estimated liability. This ensures that when the time comes to dispose of the asset, the government will still be able to collect what is owed. Smaller amounts may be exempt from the security requirement, but higher value cases almost always need collateral. Another important detail is that if conditions are not met, the CRA may impose interest charges on deferred amounts, turning what was intended as relief into an even greater cost. This highlights the need for careful compliance and proper administration of the election. The practical value of the departure tax deferral lies in flexibility. It gives emigrants time to manage investments, wait for better market conditions, or plan long-term exits from businesses without the pressure of an immediate tax hit. Yet the process can be paperwork-intensive, and the ongoing responsibility of maintaining security should not be underestimated. Individuals considering this option should consult a cross-border tax professional to assess whether the benefits outweigh the costs. For those leaving Canada before 2026, the ability to defer can be the difference between protecting wealth and liquidating at a disadvantage, making it one of the most critical rules to understand. Number 3. Tax on registered accounts. When Canadians prepare to leave the country, they often assume their registered accounts will continue to function in the same way, but the reality is quite different. Accounts such as RRSPs, RIFs, and TFSAs each have specific rules that apply once you become a non-resident. The positive news is that RRSPs and RIFs are not subject to the exit tax at the time of departure, meaning you will not face an immediate deemed disposition. However, once withdrawals begin, they are subject to a withholding tax, typically 25%. This deduction happens at the source, reducing the amount you actually receive. In contrast, TFSAs lose their tax-free status the moment you leave Canada. While Canada itself may not tax the income inside the account, most other countries do not recognize the TFSA as tax-exempt, which can lead to full taxation abroad. The impact of tax treaties plays an important role here. Many treaties between Canada and other countries reduce the withholding tax on RSP and RRIF withdrawals, sometimes lowering it from 25% to 15%. To benefit, you must file the required forms with the CRA and ensure the payer applies the treaty rate. Without this step, the default higher rate applies. The situation is less favorable for TFSAs, since very few countries recognize them, creating unnecessary complexity. In fact, in countries like the United States, TFSA income must be reported as regular taxable income, stripping away the advantage that made the account attractive in the first place. This makes pre-departure planning essential for anyone holding these accounts. The practical step is to carefully review registered accounts before leaving. Some choose to collapse TFSAs entirely, withdrawing funds and reinvesting in vehicles that are tax efficient in their new country of residence. Others may restructure RRSP withdrawals to line up with treaty benefits or even consider annuity options for greater predictability. Ignoring these rules can erode decades of retirement savings, while proactive strategies ensure your money continues to grow in the most efficient way possible. For Canadians leaving before 2026, understanding the treatment of registered accounts is not optional, it is critical to preserving long-term financial security. Number 2. Principal residence exemption changes. For many Canadians, the principal residence exemption, PRE, is one of the most valuable tax benefits they will ever receive. This rule allows homeowners to sell their primary home without paying capital gains tax on the appreciation in value during the years it was designated as their principal residence. However, once you become a non-resident, the benefits of this exemption change significantly. The rule is clear: the exemption only applies for the period in which you were a Canadian resident. If your property increases in value after you leave, that portion of the gain is taxable when you eventually sell the home. Many emigrants do not realize that future growth in value is no longer sheltered, and this can create an unexpectedly large tax bill. Complicating matters further are the reporting requirements. Even if the property is sold while you still qualify for the exemption, the CRA requires the sale to be reported on your tax return. Failing to do so may lead to penalties or, in some cases, denial of the exemption. This becomes especially important for those who decide to rent out the property after moving abroad. A change of use from principal residence to rental can trigger a deemed disposition, forcing you to recognize gains at the time the property's use changes. While elections are available to defer this tax in certain cases, they must be filed correctly and within deadlines. Without careful attention, a homeowner may unintentionally forfeit part of the exemption or face an immediate tax bill. The practical takeaway is to carefully evaluate your real estate strategy before leaving Canada. Some choose to sell the principal residence before departure, locking in the full exemption and eliminating future reporting. Others may keep the home but should be prepared for complex compliance obligations and exposure to tax on any post-departure appreciation. Consulting a real estate tax advisor before making this decision ensures you fully understand the consequences of each option. For many Canadians, the home represents their largest asset, and the treatment of the principal residence exemption can determine whether the move abroad preserves wealth or creates an avoidable financial setback. Number 1. Exit tax on worldwide assets. When a Canadian becomes a non-resident, the government applies what is called the exit tax, also known as a deemed disposition tax. This rule assumes that on the day you leave Canada, you have sold almost all of your worldwide assets at their fair market value, even if you keep them. The purpose is simple. Canada wants to collect tax on the growth of those assets that happened while you were still a resident. Assets such as stocks, mutual funds, bonds, business holdings, or valuable personal property are included in this calculation. For many people, this creates an unexpected tax bill because the gain is deemed even without selling the asset and without receiving cash. Canadians with large investment portfolios or shares in private companies are especially vulnerable, but even everyday investors can be affected if values have risen significantly over the years. There are exceptions to what is included in the deemed disposition. Assets such as Canadian real estate, RRSPs, RIFs, and certain pension accounts are excluded from this calculation because they are taxed differently when withdrawn or sold later. Still, the majority of global assets are captured, and the tax is triggered immediately upon departure. Individuals facing a large departure tax may apply to defer payment, but this is only possible if they file the proper election with the CRA and often provide acceptable security, such as a letter of credit or bond, to cover the liability. Without that security, payment is required right away. For those unaware, the surprise can be financially devastating, forcing liquidation of assets or loans just to cover the tax bill. This makes awareness and preparation essential for anyone considering relocation. The best strategy is proactive planning. Reviewing your investment portfolio, assessing the timing of departure, and even restructuring assets before leaving can significantly reduce liability. For instance, realizing gains while still in Canada at a strategic time may lower the final tax, especially during periods of market decline. Consulting a tax professional to model outcomes under different scenarios ensures you know what to expect. Ignoring the exit tax can result in tens of thousands of dollars lost unnecessarily, while proper planning ensures a smoother financial transition to non-residency. Leaving Canada before 2026 is not just about booking a ticket and starting a new life abroad. It is about understanding the financial rules that continue to follow you across borders. From the exit tax on worldwide assets to the limits on the principal residence exemption, every decision you make has potential tax consequences. Registered accounts like RRSPs, RIFs, and TFSAs can lose their advantages if not planned properly, while options like the departure tax deferral may offer relief but require strict compliance. Even after departure, withholding taxes on Canadian income, new residency tracking rules, and ongoing reporting obligations ensure that your ties with the Canadian tax system do not disappear overnight. Property ownership presents its own challenges, from rental income withholding to the underused housing tax, making it crucial to decide whether to sell, rent, or hold before moving. Finally, tax treaty benefits can help reduce exposure and avoid double taxation, but only if you know how to claim them. These 10 rules reveal that leaving Canada is not a simple goodbye. It is a complex process that requires preparation, strategy, and professional advice. By planning ahead, you can reduce unnecessary taxes, protect your savings, and ensure a smoother transition to life abroad. Which of these rules do you think would impact you the most if you moved abroad? Share your thoughts in the comments. I'd love to hear your perspective. And if you found value in this video, check out our previous breakdown on hidden money mistakes people make before leaving Canada. We put a lot of effort into bringing you clear, useful insights, so please support us. Hit that subscribe button, it's just one click.